So what are trailing stops? In this video, I'm going to go over 3 different trailing stop strategies that you can use to not only protect your profits, but also not miss out on any potential gains. Hey, how's it going? On this channel, you will learn the steps I took to go from trading with a full-time job to trading as a full-time job. So if you're new here, consider subscribing. And at any point in the video, make sure to check out the notes and links in the description below. I'll list out any valuable resources down there. Now today we are going over trailing stops. So the 3 different trailing stops we're going to talk about are going to be a moving average trailing stop, just a general price action trend trailing stop, and then a Fibonacci trailing stop. And to illustrate those, we're going to talk about a trade I previously did in another video. Now, if you want to look at the whole walkthrough of that trade, I will link that in the YouTube cards up here. So the first one we're going to talk about is a moving average trailing stop. Now, I use exponential moving averages, but you can just as easily use simple moving averages if that's what you generally use. Now, what I have found is an 8 exponential moving average is a pretty strong indicator of a strong uptrend. So if once a stock is moving rapidly in a strong trend, it'll hold that 8 moving average or that 8 exponential moving average if it's going to keep in that trend. So right here with Boeing, you can see that I bought in down here and Boeing eventually came up here, but it did have to have a pullback at some point. So it ended up coming back down to this teal EMA I have, and that is an 8-day exponential moving average. And it held that as support. It bounced along this EMA 3 times before continuing with this really strong uptrend. Eventually you can see that it did come down and try and hold this 8 EMA, but once it broke that 8 EMA, the trend reversed, and you can see now that the stock has come really far down, and you're definitely going to want to be out of the trade at that point. Now, if you were waiting for this 8 EMA to break on a daily chart, you would have probably closed out way down here, which would have lost you a lot of money. So as a stock gets extended and it gets really high from this huge move that it's going with and starts to hit Fibonacci extensions, I believe the 1272 extension was about here. And so once it hit that extension, that shows you that you need to start making your trailing stop a little tighter. And so what I mean by that is instead of using a 8 EMA on a daily chart, you start looking at an 8 EMA on a smaller time frame, so maybe a 30-minute chart. So if I change this to a 30-minute chart and zooming in on that last kind of move that there was right before we sold, you can see that the stock with this large trend is essentially holding that 8 EMA. And then once it breaks that 8 EMA right about here, that is when you want to sell, because the main idea here is that this uptrend, this really strong trend that it's having, is over, and that on a larger time frame the stock is extended based on those Fibonacci extension levels. And so you're going to want to use that as a signal to get out of your trade, or potentially get out of some of your trade. You don't have to sell everything at this point. You could sell some of it, and then based on another trailing stop in a larger time frame, you could sell the rest. The whole idea behind trailing stops is that you are capturing the easy money. Maybe the trend is going to keep going here, but the easy, really strong trend where you're not going to have to sweat losing any of your profits is over once it breaks this 8 EMA over here. But also what it does is it allows you to stay in the trade. You don't have to worry as the stock goes up and starts having these little pullbacks in here that's going to be potentially the end of the move. This gives you a really concrete way to be completely emotionless and robotic with your trading, and so you have a defined strategy on when you're going to sell. If you just go into every trade with the mindset of selling when you think it's going to be the right time to sell, you can be missing out on a lot of potential gains, and a trailing stop allows you to manage your gains so you don't miss out on it, but also manage your losses so you know when it's time to get out. For our price action trailing stop, this is going to be more on the idea of if the stock is creating higher highs and higher lows. So all that is if the stock is kind of making this upward zigzag fashion, and initially when you're in the stock, you're going to want to have it on a, again, just like the last one, you're going to want to have your trailing stop on a larger time frame, because you want to give the stock space to have your idea be right. Initially, when you're in a stock, sometimes it can be, right when you buy it, it can be a little bit more choppy. And then once it really starts to do that breakout, that's when you want to have your trailing stop get tight. So you want to tighten your trailing stop when it starts to get into this kind of area of the trade. You want to have a larger trailing stop when it's in this kind of area of the trade, because you don't want to get stopped out on a little down move like one of these and then have this stock just rocket up without you and realize that, well, you were right. And if you didn't have a tight trailing stop like that, you would have hit the trade and had a perfect trade. Having a wide trailing stop in the beginning, and then as the stock starts getting extended in the direction that you're trading, and tightening your stops up then, is a lot safer way to protect your profits and also not get stopped out of the trade before it really happens. So once we would have got into this area up here, again, seeing that the stock was just taking off like this and hitting these Fibonacci extensions up here, we would have want to go into another shorter time frame chart. So again, we can just use a 30-minute here as an example, but you always want to try and fit your time frame for what you're trading. So that could be a 5-minute or even a multiple hour chart, just depending on what your trading time frame is. So looking at this chart on a 30-minute time frame now, once it started to get in that huge up move here, we can see that it was following that higher highs and higher lows mentality here. And that's how we would have wanted to keep in the trade. We don't want to close the trade until it breaks that. So the trade, once it came down here, it actually broke that last low, showing you that, well, this higher high and higher low trend is now changing. And then you definitely got a confirmation here when it made a lower high. And then as you can see, it started in this downtrend. And so that can be a place where you would want to close out this trade when it breaks down there, because again, the easy money is gone. This short time frame trend is over. And with the stock already being extended on a daily chart, even though this is a 30-minute chart, this is going to probably be the last kind of leg up or strong up move before it has that huge reversal on a daily chart. And you're not going to want to hold through that. If we zoom back out to a daily chart, you can see that the stock has now come down really far, and you're not going to want to hold through that, because now it's basically back to where I previously bought in. So for our Fibonacci trailing stop, we're going to again zoom back out to this larger time frame, and I'm going to take a Fibonacci retracement of this larger swing here. So I'm going to take this high to this low, and that's going to show us these levels. Now, the basic idea of how this kind of fib trailing stop works is as the market breaks through these fib levels and then comes back down and taps them and uses them as support, we don't want to see the market fall back through that fib level again. If it falls back through that fib level again, we're going to say that this trade is over and the easy money is gone, because this could potentially say that the stock is going to keep falling and start a new downward trend. So zooming into this to walk you through that, we have this initial entry level fib area. You can see that this is the 618 and it's starting to hold this. If the stock ended up coming up here, bouncing off that 618 level and then selling down through it and breaking that zone, that's where we would have wanted to sell, because that fib level is broken. Moving on, as the stock moved up, this 786 level would have been our next level of support. So as the stock broke up through it, it's going to be support now. And you can see that this stock did hold it as support. Once it bounced off of that level and started to come up here, we wouldn't have wanted to see the stock fall through here and break this and area of support that we previously held. That would again signal that we're breaking through that support, and this could signal a start of a downtrend. Once the stock broke up all the way above this 127, we would have wanted to see again it hold that 127 for us to continue holding this trade. Zooming into a smaller time frame chart here, once the stock broke above this 127 level, it came down and hit that 127 level and bounced off of it as support here. And you can actually see that the stock then came down and bounced off of it again, and then started to make that next move higher. And this would have been looking great for the trade to keep going up. But again, if it came down and broke through this level, we would have wanted to close out on the trade because it's breaking through that support. Looking at this now, you can see that the stock did trade and break through this support level. And that is when you would have wanted to close based on this trailing stop strategy and cover your profits, because the likelihood of this starting a downtrend now is pretty high, and you don't want to have to sweat a large pullback for making further gains. With all these trailing stops, initially you always want to have a larger stop so you don't get knocked out of your trade sooner than you wanted to. And then once the stock gets higher and higher into these fib extensions, you want to tighten up your trailing stop, because as the stock goes higher and higher, the likelihood of it reversing gets higher and higher. So you want to protect your gains. But again, these trailing stops are amazing because they allow you to stay in the trade essentially to the top. With this trade right here, I definitely didn't sell right at the top, but looking at the chart on a larger time frame, you can see that I got pretty dang close to selling at the top. It essentially looks like I sold at the top. And so these trailing stops are really powerful for doing that. You never have to be worried about making a wrong decision when closing a trade for profits, because these strategies are very strong in showing you that the easy money is over and that you should get out and then just start focusing on another trade. Yes, the stock can keep going up, but again, there's no way to predict anything in the stock market, and generally stocks will fail at these extensions. Sometimes you can get stocks that just keep going and going, but 9 times out of 10, they're going to fail at the 127 or the 1618. And so these trailing stops allow you to close at those levels, but also allow you to keep the trade going if it keeps going higher. Hey, thanks for checking out this video. If you want to learn more about how to use those Fibonacci levels and use Fibonacci in your trading, make sure to check out my playlist on Fibonacci right here. Now, if you want to just learn more about trading in the stock market, make sure to subscribe. And if you have any questions, don't hesitate to ask them in the comments below.